Good afternoon, ladies and gentlemen. Welcome back to this weekly market review. Market has been going through a very difficult time, so we are here to handhold you. Together with me here today is Mr. Gerald. Gerald, how are you?
Hi, very well. Like you mentioned, the markets have been volatile. We get more questions from different retail investors in Singapore asking what is actually driving the weakness in the market. How should we react to some of this volatility? So, hope to be able to provide some updates in today's weekly market review.
Yes, indeed. Market has been pulling back for quite a few weeks now, especially on the US side. But Singapore still seems to outperform last week, despite the US major indices down 2 or 3%. STI was up. I was also looking at the IHS REIT index, which was also up. So I think I'll let Gerald take you through some of the developments on the Singapore market today.
Okay, thanks, Sunny. The usual disclaimer that today's sharing is for information purpose only and should not be taken to be financial advice. Okay, we have an upcoming Ask SIAS on the 12th of March. If you've got more questions for myself and for Sunny, do join this Ask SIAS this coming Wednesday. Okay, if you find the weekly market review helpful, leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can go to this website, sias.org.sg/membership, or scan this QR code. As a SIAS member, you'll be able to access various online resources as well as investor education programs. Okay, so like Sunny mentioned earlier, we saw further weakness in the US market. The S&P 500 was down by 3.1%, even with the slight rebound that we saw on Friday. Okay, the losses were led by the tech stocks, in which we see that the Nasdaq was down by 3.5%, and some of the very popular tech names, such as Tesla, Nvidia, actually falling by a more significant amount. Okay, closer to home, we saw the STI actually outperforming with a 0.5% gain and now above the 3,900 levels. Okay, so what is driving this weakness? I think if you have been following the headlines, there's been a lot of news about the tariffs in the US. If you've been following the weekly market review, that is what you have seen as well. So 1 week, we have seen more tariffs being implemented. Next week, we see some news about a delay in the tariffs. So all of it is driving a lot of uncertainty in the market. Okay, and overall, we have seen that it is leading to weakness in consumer sentiment in the US as the consumers cut back on their spending because of this uncertainty about whether the tariffs are coming in. Likewise, in terms of the employment data in the month of February, we saw that the non-farm payroll data was a bit weaker than expected. So all of it is driving investor concerns about whether this tariff uncertainty is going to drive an economic slowdown. Okay, so with that, we see investors raising their expectations of interest rate cuts by the US Federal Reserve. This is the expectations for the Fed funds rate by the end of this year. We see that the most likely probability is for it to be 3.5 to 3.75%. So compared to the current rate of 4.25 to 4.5%, that would imply potentially 3 rate cuts for a total cut of 0.75%. So what this means is that investors have raised their expectations of potential rate cuts due to the economic uncertainty. Okay, so with the rising expectations of the rate cuts, we have seen bond yields falling as well. This is the 1-year US government bond yield, now at 4%, having reached 4.3% just in February and as high as about 4.4% in late 2024. So with the economic weakness, investors are raising expectations of potential rate cuts, and the bond yields have fallen as well. Okay, so earlier we saw the STI outperforming US stocks. We see here the top performers for the STI last week. A big part of the strength is driven by ST Engineering, that we've already gone through in the weekly market review last week. But all of the strong earnings that they reported, as well as the increased expectations that governments will increase their defense spending, is helping to boost sentiment on STE. Okay, next we have UL also up by close to 8% because of improved sentiment towards the property sector in Singapore. And we have got Sembcorp Industry, SETS, and CICT. Okay, in terms of the top losers, we have got a number of the Jardine name stocks, including DFI Retail Group down by 4.1% and Jardine Cycle and Carriage down by 4%. Okay, so I think with the STI actually close to 3,900 points, we've been getting still a lot of questions about the Singapore REITs as to why their prices have been so weak, even though we have seen some of the bond yields starting to come down. So there are two names that I want to go through today. They are large cap names, blue chip REITs in the Singapore market, and we try to understand what is driving weakness in their share prices. The first one is Mapletree Industrial Trust. We see here at about $2 per share, down from about $2.55 in September last year. Okay, so just a summary about Mapletree Industrial Trust, we see here that now data centers is a big part of their total portfolio, representing 56%. Okay. And in terms of their portfolio, most of these data centers are actually in North America. So this is an important point to highlight and to take note of as I'll go through what is driving the weakness in Mapletree Industrial Trust share price. Okay, so just as a recap of their most recent earnings, we actually saw decent DPU. It was able to report a 1.5% increase in their distribution per unit. So one of the REITs that actually managed to still grow their DPU, but what we see is that the share price has continued to come off. Okay, so if I were to try to break it down further, this is a breakdown of their occupancy rate. What we see here is that the overall portfolio occupancy came down to 92.1% from 92.9% in the previous quarter. Okay, if I were to look at what are some of the segments that are facing lower occupancy, data center has come down to 91.6% from 91.9%. Business park is also very weak to now 80.1% from 80.6%. Okay. So I think for business parks, we have shared about some of the weakness that we see in this market. But what I wanted to go through a bit more today is the exposure to data centers. Okay, so if I were to look at Mapletree Industrial Trust, they've got 56 data centers across North America. What we see here is that the occupancy rate is 90.3%. So lower than what we see for the entire portfolio occupancy and also lower than the data center occupancy rate. So I think what has been noted is that there's been some weakness in terms of the demand for data centers in the US. We are seeing some of the tenants for Mapletree Industrial Trust actually not renewing their leases. So that is something that has caused concerns around whether there is going to be sustained demand for these data centers. Okay, at the same time, if you recall from our previous weekly market review, because of the development of DeepSeek, the Chinese AI company, that is driving concerns also as to whether we'll see sustained demand for data centers if the new AI applications do not require so much of the computing power that will then also require the data center space. Okay, so what is Mapletree Industrial Trust doing to mitigate some of this? They've identified three key drivers that they want to be taking on. So reletting, repositioning, and rebalancing. So for reletting, engaging tenants ahead of renewals, such as what they did for an asset enrichment. And then for the other strategy here, it is really trying to backfill the vacant spaces with high quality tenants on long-term leases. Okay, so what they have shared is that 76% of the expiring North American leases in the FY 23-24 and FY 24-25 had been renewed/leased. Next, they're also looking to reposition some of these assets, either through redevelopment or by repositioning them for other users. Okay, and last but not least, they are divesting some of the non-core properties and diversifying their exposure geographically. So one of the ways that they are diversifying geographically is through expanding in new markets, such as in Japan. So what we saw here is that earlier they announced an acquisition of a mixed-use facility in Tokyo. This will comprise a data center as well as some adjacent facilities together with it. Okay, so this is one of the strategies that Mapletree Industrial Trust is taking on to be able to diversify away from US data center exposure. Okay, so if I were to look at the valuation of Mapletree Industrial Trust now, from a price to book perspective, it is still fairly elevated, now at 1.15 times versus the historical average of 1.08 times. But if I were to look at the dividend yield perspective, since they've still been able to sustain the dividend payout, and with the fall in the share price, the dividend yield is now at 6.5%, which is above the historical average dividend yield of Mapletree Industrial Trust. Okay, so the next name I wanted to go through is Frasers Logistics and Commercial Trust. A similar trend that we saw for this large cap REIT, having fallen quite significantly from September till now, and we see that it is actually hitting a new 52-week low. Okay, so as a recap of Frasers Logistics and Commercial Trust portfolio, as the name suggests, a mix of logistics and industrial assets, as well as commercial assets. Okay, the assets are in different markets. Australia is the key market, representing about 47% of the portfolio, and Singapore would be at 13%. Okay, so in contrast to Mapletree Industrial Trust, for FY 2024, we saw Frasers Logistics and Commercial Trust having a decline in the distribution per unit, but it is a marginal decline of about 3.4%. So not as significant compared to what we see for some other REITs. So with the moderate decline in the DPU, the question is what is driving this weakness in the price of Frasers Logistics and Commercial Trust? Okay, so if I were to look at once again a further breakdown of their portfolio, the occupancy rate on average is at 94.3%. The logistics and industrial assets are doing much better with the overall occupancy at close to 100%, while the commercial portfolio has an occupancy rate of 85.5%. Okay, and if I were to look across the different markets, Australia is where the weakness is. Where we see that the occupancy rate is actually lower compared to some of the other markets that are outside of Singapore. Okay, in terms of what we see for the different commercial assets, the Alexandra Technopark in Singapore has seen some weakness in terms of the occupancy rate, where we see here that the occupancy rate as of December 2024 at 84.1% versus 85.9% in September 2024. Okay, so this is a breakdown of the assets across logistics and industrial versus commercial. And once again, we see here that the weakness is in the commercial portfolio, where the reversion in the most recent quarter was at negative 9%. Versus the logistics and industrial, which was at positive 21.3%. Okay, so that's why on a blended basis, we just saw a 1.8% positive reversion for Frasers Logistics and Commercial Trust portfolio. Okay, so what is it doing to be able to mitigate some of this weakness? It is taking on some acquisitions as well. So in this case, it's acquired a prime logistics property in Singapore. It is actually intended for it to be able to increase its exposure towards the Singapore logistics space, where the underlying fundamentals might be stronger compared to some of the other assets. Okay, on top of it, So with the acquisition of the Singapore asset, we have actually seen an increase in the gearing of Frasers Logistics and Commercial Trust. It was at 33% in September, but it increased to 36.2% in December. So part of it was driven by the debt taken on to acquire the logistics property. We saw the distributions by the REIT, so that also further increased the gearing. And then last but not least, because of some of the weakening in the regional currencies, such as Australian dollar, euro, and the pound, so that led to a further increase in the leverage of Frasers Logistics and Commercial Trust. Okay, so one important point to note here is that because of the weakness in the Australian dollar and because about half of Frasers Logistics and Commercial Trust exposure is to the Australian market, so that's impacted the distributions as well as the gearing level. Okay, so what we see here for the DPU for Frasers Logistics and Commercial Trust is that it has been declining for the past few years. And in the last fiscal year, we saw a further decline in the distribution per unit of Frasers Logistics and Commercial Trust. Okay, at this point in time, with the fall in the share price, it is trading at a price to book valuation of 0.74 times, which is below the historical average. And if I were to look at the dividend yield of Frasers Logistics and Commercial Trust, currently at about 8.3%, which is fairly high for a industrial and commercial REIT. Okay, so I'll share more about two REITs with fairly high distributions. In terms of what to look out for in the coming week, we have actually the US CPI data coming out on Wednesday. So that's something that will keep us further informed as to the pace of inflation in the US and whether we'll see the Fed cutting interest rates as expected. Okay, we also have the 6-month T-bill auction coming out on Thursday. So those are the few key things that I'll keep a lookout for. And I think those are things that might be worth looking out for as well. Okay, so with that, I'll hand over to Sunny, who will provide us with the update on the technical analysis.
Okay, thanks, Gerald. Yes, indeed, we are going through a difficult time in the market right now, but having seen that STI is still outperforming, so that is still a positive sign. So, in case you are looking at where to park your money, at this moment, the US may not be the first choice, may not be the optimum time to go back in the US market because of the volatility and uncertainty. You may look at the STI index for growth as well. So last week, I actually read the news that DBS actually raised their sort of forecast for the STI index due to the additional liquidity injection from MAS, and they are targeting that the STI could be ending above the 4,000 mark to 4,080 points level from their previous forecast of 3,950 points. So this is one of the bright spots in the market that you can look out for. So with that news that we saw last week on the Singapore market, let me start with the recap of the STI index on the charts first. So the all-time high is still at the 3,951 points level, which we saw on in February. So the STI has also sort of a pullback from that high on 24th of February as well, but we are now holding tight to the 20 days moving average, which is around the 3,906 points level, which is also what we are seeing on today's reading as well. Okay, so today, this early morning, we are down about 0.2%. So STI holding on to the 3,900 handle. So STI has been trending above the 20 days moving average since the beginning of this year. There has not been much of a significant pullback on the STI because of the very good performance from the banks as well as some of the industrial names like STE that Gerald mentioned. Okay, so if you're looking at getting into the STI index, looking at indicators, MACD reading is negative, so there's a downtrend momentum present now in the STI index. The RSI has also been on a downtrend after hitting the all-time high on 24th February. So we are at a 55-point reading, so it's still positive above the 50-point neutral mark, but the momentum is very weak. So what we are trying to observe is the the RSI touching the 50-point neutral mark, which is what we see in early part of January. And if it dips below the 50-point neutral mark, like what we see in December, that could be the buying opportunity on the STI index. So where could those support level be if STI were to sort of pull back a little bit more? The lower bound of the Bollinger Band at 3,866 points, the black line that you see here, with the 50 days exponential moving average at the 3,852 points. So 3850 would be a clear support level for the STI index. So referencing what we see in December as well, once it touched the blue line, the 50 days EMA, it also rebounded convincingly, which is also what we observed during the November period as well. Okay, so STI is still very stable. Year to date, we are up about 3%. So this is still positive compared to some of the US index, which has given up most of their gains for this year, with Nasdaq going into correction territory, which means it's down more than 10% from a recent high, and also the S&P 500 dropping below the 6,000 mark, and now we are dropping. We have pulled back about 5% since the beginning of the year. Okay, so let me now move to the US indices, which a lot of people are concerned about. Okay, so let's start with the 30 stocks Dow Jones Index first. So we peaked somewhere in the end of January period on the Dow Jones Index. This is January, like I repeat again, is always typically a very good period for the Dow Jones Index because we see the big banks' earnings. And usually if economy is in a good state, the banks will likely perform well, and hence it will usually carry the Dow Jones Index up in the January period. And since February onwards, last month, we can see that the trade war, trade tariffs news starts to sink in. There's a lot of updates every other day on what Donald Trump is saying, what the US administration is saying, and that caused a lot of volatility. And investors, when they experience or foresee volatility ahead, or they are uncertain of what is going to be expected, then definitely they would like to seek shelter first before reassessing the situation again. So the Dow Jones Index has pulled back quite a bit. Previously, we identified the 100 days EMA, which is the amber line that you see here, which has always been a good indication of a support for the Dow Jones Index, like what you see in December. That failed to hold on because of more tariff news. And of course, on top of that, we also saw a series of negative macroeconomic data, which is showing signs that the US economy is actually slowing down. And the latest one is the non-farm payroll data. Although in my opinion, the non-farm payroll data at 151,000, about 20,000 below the 170,000 forecast, is not an alarming drop, but it's not a positive sign that economy is doing well. It is signs that economy is slowing down. Okay, so as we go through all this data together with the Trump tariffs, which is not very positive, the Dow Jones Index broke below the 100 days EMA, and hence we are now approaching the 200 days moving average, okay, which is at 42,028 points. So as of now, I believe the trade war issues, the trade tariff issue is still a negotiation tactics by Donald Trump. So it may take a few months to blow over or to settle down to find a amicable solution between the countries. So definitely, I think index in the next few weeks is going to be pressured. But I think the 200 days EMA on the Dow Jones Index will likely hold on at least for the next few weeks until we have more clarity on the situation. So if you're thinking that this pullback is an opportunity, the 200 days moving average on the Dow Jones Index at 42,028 points, that could be a level that you would want to consider to accumulate further on the Dow Jones Index. Okay. Next, let us move to the broader index of the S&P 500. We just saw the S&P 500 touch a new all-time high on 19th of February, about 2-3 weeks ago. So that is still fresh in our memory. But then now we have put back like 5% for this year. We have gone into negative territory in terms of year to date because we opened somewhere around here, and now we are below that level. Okay, so the S&P 500 actually tested the 20 days EMA level, which is at 5,710 points last Friday. So it managed to close above that. So I take that as a positive signal that the 200 days EMA is still likely to hold on for now. And if I look at some of the technical indicators reading, we still have a very negative reading from the MACD indicator. So that means that the downwards momentum is still present. But we can see that gain in negative momentum has been alternating between the stronger downside momentum to a weaker to a stronger in the past few days. That could be due to the tariffs update that we get, but it's also showing signs that there are some kind of a technical buying coming in from the market as well, at least. So there is a little bit of support coming in on the S&P 500 index, but then it does not mean that we are going to see a rebound soon. We are still in a downtrend with downwards momentum still present right now. The RSI is still in a very weak territory at 36-point readings below the 14 days RSI MA of 43, but then we have not gone into the oversold level yet, which is the 30-point reading. So that means that we may still have some room to trend down further on the S&P 500 index. But I believe in the near term, the 200 days EMA would likely still hold on to the 5,700 points level. And that could also mean that this is a critical support juncture that the index is looking at. Okay. Next, let us move to the Nasdaq Composite Index, which has the most attention of the traders and investors recently because it has dropped more than 10% from its recent high already, which was in December. That means that we are into correction territory. We have also breached the 200 days EMA at 18,319 points. So that means that the index is, let's say, if we are going to trend down further, let me have a look at the futures reading. Okay, Nasdaq futures is down about 0.6% this Monday morning. So there could be a possibility that the Nasdaq may pull back further again and push us towards the crash territory of a 20 points pullback. Okay, so looking at the Nasdaq index now, definitely I believe the exponential moving average of the 200 days at 18,319 points will likely be a support that the index would want to try and regain to make sure that we don't move towards the 20% drop, which is a crash reading. We believe this is still a correction in the making for now. So looking at the indicators, we have a very negative reading, although that we try to make a sort of a regain some ground or pullback on last Friday. That we will need to see whether that pullback or that rebound will likely continue for this week ahead. Okay, and that could be sort of a dependent on the CPI data that we are likely going to experience or on sort of record for this week that have an impact on where the Nasdaq could be moving. On the RSI, it is also very weak now. The latest reading at 34, 14 days moving average of the RSI at 44 points away from the oversold level, and there could be traders who are trying to who would want to test some of the stop loss level and push the Nasdaq towards the RSI oversold level, and hence it's only then that we could see some kind of a further technical rebound coming in. So I think the Nasdaq Composite Index could be testing the 18,000 level this week before any sort of a bigger rebound would come in on the tech-heavy index. Okay, so these are the updates that I have this week on the indices. Anything else to add, Gerald?
So indeed, we are at a very volatile time for the market. I think that means that we have to keep a close lookout for some of the upcoming economic indicators. And this week, we have the CPI data that is coming up. So that is something that will definitely provide us with more clarity about what the Fed is going to do going forward and what the market is going to react as a result of that.
Yes, okay. So I think, like I always say, in the meantime, trade safe and stay tuned to our next weekly market review, where we will update you with the latest market movement to help us navigate the markets together safely. Okay. So from us to you now, have a good trading week ahead, and we'll see you again next week, next Monday, same time, same place on the weekly market review. Goodbye.
See you.